So this question is called Alexander. It's from the June 2011 P2 paper. I think it's quite similar to the way that the examiner has said that he wants questions to appear, very much discussion based, relatively few numbers. So it's a 25-mark question. There's 2 marks for professional style and presentation. So let's make sure we set it out in a way we answer all parts of the question. He has split it into 4 smaller questions. So don't think of it as a 25-mark question. Think of it as a 6 and a 5 and a 5. And then in your head, as you're going through the questions, have I written 6 points? Have I written 5 points? And things of this nature. So the first thing that we see is a default on an interest payment. So we've issued a bond. So the bond issued would be classified as a financial liability per IFRS. It will be measured using the amortized cost method. In this case, there is no difference between the issue and the there is no difference between the issue and the redemption price. So the nominal interest rate be the one charged in the statement of profit or loss. But we then have a timeline. Now, one of the things I'd always look at in an exam question is when is our year end? Alexander's year end is the 30th of April 20x0. So 20x1. And the bond is repayable in 20x5. So in previous years, Alexander would have classified the liability as non-current in nature per IS1. Again, you don't have to state the standard, just put IFRS, per IFRS. This is because a non-current liability is one that is due for repayment in more than 1 year. So just state, and you all know that. Now, that's nothing new, still potentially worth a mark. Then I'm looking at these dates in the question. In November 20x0, Alexander defaulted. Now notice I'm using the name of the company as often as I can. That makes the answer more personal. So I'm just thinking about a marker who is potentially marking this. The markers, I don't know how many papers they're going to mark. There's be probably many hundreds. And if it just says the company, if we start to make it, it's just simple things, just slightly more personal, it just connects slightly more. So all I'm going to state here is what happened in the question. Alexander defaulted per the bond terms. The whole sum would then be repayable. Therefore, the loan should be reclassified at this date as a current liability. The bondholder issued a waiver postponing the interest payment until the 31st of May. When the bondholder waived the payment of interest, it would appear that Alexander was no longer in breach of the loan, and so it can once again be classified as non-current. On the 17th of May 20X1, Alexander requested a further waiver of the payment due. This is likely to be classified as an event after the SFP date, assuming that the financial statements have not been approved by this date. The request for a new default gives extra evidence about an item which was uncertain. And what was the item which was uncertain? Whether Alexander would make the payment. As such, it is classified per IFRS as an adjusting event. Okay, this goes back to what we've learned to F7. You cannot afford to ignore topics which have been covered at earlier parts of our studies. It would therefore appear that the loan should once again be classified as current in nature, as Alexander would be in breach of the new payment date. Now, if the lender agrees to this extra waiver, then once again we are not in breach, so once again you'll be able to classify as non-current in nature. And this is classic P-level exams. There is not necessarily a right answer. What is important is that you can go through a thought process and you can put forward a comment or an argument that has logic and that has value. this is what we're doing. We're nearly qualified accountants, so therefore you're expected to come up with suggestions which have value. The inability to make the interest payments calls into question whether or not Alexander is a going concern, especially if it has to repay this $100 million. The directors should have a full review of the business to determine if the going concern convention is still applicable. If it is not applicable, then the assets should be measured at a breakup basis, or on a breakup basis, and an impairment taken to the statement of profit or loss. So this will be an example of when an impairment review is required. Both non-current assets and liabilities should be transferred to current as the business is unlikely to have a life of more than 1 year if the going concern rule no longer applies. So that's the first item. Our next item in this particular question are contracts. The supplier solves system problems and provides new release and updates for software. Alexander provides maintenance services for its customers. So according to IFRS, we use a 5-step model when recognizing revenue on contracts. The 5 steps are: contract identification, obligations, price, allocation, and recognized revenue. Now, I tell people that I use the first letter on each of those. I always tell people it's copper. Okay, that's how I remember my 5 steps, copper. I think it's a useful one to remember. Oh, Microsoft. It varies from question to question. So we have our 5 steps. Alexander is providing maintenance services, and so the obligations for Alexander arise over the length of the contract. Which is usually 2 years. Do you see, all the time I'm picking up information from the question and I'm just putting it back, but I'm making it as relevant as I can. Alexander's revenue recognition policy is therefore incorrect what have they been doing? It says Alexander recognized revenue and costs when the customer was invoiced, which was at the beginning of the contract. So this is because at the beginning of the contract, not all the obligations had been delivered. This is a fundamental error. And so a prior period adjustment is required. This will mean that Alexander has to restate the opening balances for the adjustment to revenue recognized in previous years. Profits will fall, and so will costs, because these were also recognized at the start of the contract in previous years. It says during 20X0, Alexander acquired Xavier, which recognized revenue derived from a similar type of maintenance contract on a straight line basis over the term of the contract. The accounting policy of Xavier appears to be in line with the rules of IFRS, and so no adjustments would be required. Okay, so it says in the year to the 30th of April, Alexander recognized revenue and related costs on a straight line basis over the contract term. The switch to the new policy is not a change in an estimate. It is a change of policy. And therefore, again, should be dealt with by changing opening reserves. It is unlikely that profits will fall by the full 6 million shown in the question, or shown in the scenario, because costs will also change. So all the time, short points, relevant points, trying to keep the question, or trying to keep my answer in such a way that I'm generating marks all the time. So next we're looking at payment of the board. We've got a management and a supervisory board, and it pays its board. We've got a salary, bonus, and share options. And in the group financial statements, it disclosed the total remuneration paid to directors and non-executive directors, and a total for each of these. No further breakdown was provided. Per IFRS, payments to related parties, which includes all directors, should be split between short-term payments, which would be the salary and bonus. There is no need to show these separately. Long-term payments, which is payments to the pension scheme, and share-based payments. Alexander is incorrect by simply showing the total paid to the board and the non-executive directors. There is no need to show the amounts paid to individual directors, because that's one of the issues here. Alexander was of the opinion that they didn't want it to be traced back to certain individuals. That's fine, there's not a problem there. There may be local rules in local company legislation that result in extra disclosures. Okay, again I've got 4 or 5 points there, perhaps struggling a little bit on that one, but I could have written more if I'd really needed to. Here we've got a pension, and what is the examiner asking us for? Is it a defined contribution or is it a defined benefit scheme? So surely we would start off by saying, well, this is what a defined contribution scheme is, this is what a defined benefit scheme is, apply the rules. So in your head, break the question down. When I write an answer for a question of this, I would actually scribble on the page. I would create a mind map of all the points and all the processes that I go through, and then I would use that as the basis for forming my answer. So a defined contribution pension is where the employer and employee pay in fixed amounts These are invested and used to pay a pension which varies according to the success of the investments. A defined benefit scheme is where the pension is determined in advance usually based on a formula. The key issue between the two is identifying who has the investment risk. In a defined contribution, the employee has the risk and a defined benefit the employer. Okay, short sentences, one idea per sentence, just apply those rules. Now let's take a look at Alexander's pension plan. It was previously accounted for as a defined benefit, but now we're treating it as a defined contribution. Alexander's decision to treat the pension as defined contribution is incorrect. This is because they've had a review of the pension liabilities are indexed. There's a lot of information here. The pension is guaranteed. And so Alexander bears the investment risk through the level of premiums paid to the insurance company. If there is a likely shortfall, on the pension, the insurance company will increase the premiums. So Alexander is bearing this risk. In addition, Alexander has the risk when the employee leaves of paying the difference between the pension benefits and the insurance premiums paid. So everything I'm writing, I try to keep things as brief as I can. I've not written a huge amount, because I don't think it's realistic to expect you to write huge amounts. But every sentence I've tried to ensure is going to potentially earn me a mark. So I would certainly pick up the 2 professional marks because I've covered all of the issues, and I'd be looking for a mark of 20 plus in respect to that question.